Well, certainly the markets may be in for a wild ride today after the president flipped foreign policy on its head. Here to talk about the possible impact is Raymond Neil Franco. He's the head of research at Abacus Securities, and he joins me live from our Manila bureau. Raymond, thanks for being with us. Big news today with Duterte formally announcing a breakaway from the U.S., both from a military and economic standpoint. What do you make of this? Or is the better question, how worried are you guys about this?
Well, there are several angles from which to look at this issue. From our point of view, from an equity investor's point of view, it certainly is not going to help. I think the last few weeks have seen some outflows of foreign funds, and I think this is something that could continue that trend.
Raymond, it's interesting to note that the PSE was actually rallying in the days leading up to Duterte's China visit, and whilst he was there as well, some analysts chalked it up to over-exuberance that we will see a flood of Chinese money soon. How much upside can we actually expect, bearing in mind that China has strict rules over capital movement?
You're correct in citing that fact. And even though it was announced that $13.5 billion worth of deals were sealed or announced, it's going to take a lot of time before that actually comes to the Philippines, if at all. Because, as we all know, China is also undergoing change of its own. They're trying to transition from an investment-led economy to one that is more consumer-driven. And that is causing troubles for China at the moment. They're trying to slow down the economy without it going through a hard landing. So it might be a long time before we see a trickle of that $13.5 billion coming into the Philippines.
I mean, I'm thinking here at this stage, the FDI might come in a bit later. I mean, a few years out perhaps. But also, if you take a look, what about exports? I mean, you talked about China's rebalancing. Could we not see an uptick in exports at the very least as they try to move to a consumer-driven economy?
They have said that they're going to open their markets to more agricultural exports from the Philippines. However, we're not yet very clear as to how much this is going to help our export figures, because it might be a case of just transferring some of our exports from other countries to China, because right now we don't have that big a capacity in our agricultural sector to meet the demand from China. So maybe we're going to divert some of our exports from the US to the US or to Europe, and then just export it to China. So this is going to help our exporters still, because the cost of exporting to the US or Europe is definitely higher than exporting to China. But in terms of huge volumes or huge value of additional exports, that might also take several years.
Raymond, let's shift gears a bit. I note with interest your stock picks: SEC, Security Bank, East West Bank, and First Gen. Let's focus on the financials. SEC and East West have vastly different stories. Yes. Year to date, SEC is up almost 63%, while EW, East West, rose barely 4%. What's the common theme here?
The theme is common actually to the entire banking sector. We believe that it is the best GDP play moving forward that is not exposed to policy risk from the new administration. Just to explain this further, we've seen a lot of headlines about the mining sector, the gaming sector. We've seen pronouncements from the Department of Labor that will probably affect labor costs moving forward. So we see the banking sector as one of the safe sectors that's not prone to policy risk from